Welcome to Countarts. In this lesson, we're going to look at the property, plant and equipment, or PPE. We are specifically going to look at how to do the PPE note. So we'll go through a thorough example. What is PPE? PPE is non-current assets recorded in the balance sheet or statement of financial position. It is found in the assets section under non-current assets. So all non-current assets will fall under property, plant and equipment. The PPE note offers details of each specific non-current asset and their movements. So let's look at this example. We're given a question here and we're told that the following information was obtained from the accounting records of T Super and B-Man trading as Superman traders. And we're given balances as at 28 February 2011. So these are the balances here in the table. So in this table, you can see that the figures have moved a bit down, but I'll be able to highlight as we go along. And we are also given additional information down here, which will be very important and key when we are doing the PPE note. Another thing that we need to pay very careful attention to is the dates that we are given. Here we are given the balances as of 28 February 2011, and we are also given dates in additional information. So we need to pay very careful attention to that if we're going to do the PPE note correctly. So here's the requirement. We are asked to prepare the property, plant and equipment note as of 28 February 2011. Here's the table that we are going to use. We've already drawn the table for the sake of time. I've already identified the assets which are non-current. So we have land and buildings, equipment, vehicles, and then we have total at the end. And how do we begin with the PPE note? We have carrying amount as at 1 March 2010. That is the beginning of this period. Remember, we asked to do the PPE note as of 28 February 2011. So we will first begin by putting the carrying amount at the beginning of the period. And we get the carrying amount by looking at the cost and deducting the accumulated depreciation. So we take cost minus accumulated depreciation. Remember, this is at the beginning of the period. And then we look at additions. Did we have any additions to our non-current assets? If we did, then we'd put all the additions here. Then next we do at disposals at carrying value. Did we have any disposals, or did we sell or get rid of any non-current asset? We'll put the figures there. Then next we have depreciation for the year, and this is the depreciation for this specific year. And then lastly, we have the carrying amount as at 28 February 2011. So this is the carrying value at the end, or the carrying amount at the end of the period. This is the carrying amount at the beginning of the period, and then here we have carrying amount at the end of the period. And then we also have cost and accumulated depreciation. So for us to get the carrying amount at the end of the period, we take cost minus the accumulated depreciation to get the carrying amount at the end of the period. So that's how the table works, and this is the table that you'd be required to draw when you're asked to do the PPE note, or property, plant and equipment note. So let's begin. We're first going to plug in the costs here. So now we have to see what costs do we have. So let's start with the land and buildings. Remember, we pay very careful attention to the dates that we are given. So what is the cost for land and building? So let's go to our table and see the land and building. There is land and buildings. I've drawn an arrow so that you see which amount we're dealing with. So you see here, the land and buildings were given an amount of 1.5 million. So 1,500,000 rand. But that is not what goes here, because we are told these are balances as at 28 February 2011. So if you are not given any date here in brackets, then we know this is the value, or this is the balance at the end of the period, at the end of this period. So before we plug in the figure, let's go to additional information to see if there was any changes to land and buildings. 2.1 tells us that land and buildings consists of land which was bought on 1 March 2008 for 900,000 rand. What does that mean? 1 March 2008, that is before the beginning of this period. So that means at the beginning of this period, that is 1 March 2010, we had this land at this cost, 900,000. What about buildings? We're told that the building was erected during the year at the total of 600,000 rand and was only occupied on 1 January 2011. So the building was erected during this year, but we want the balance at the beginning of this year. That means the building did not exist at the beginning of the year. So what do? We're going to take the land and buildings at the end of the year or at the end of the period minus the building which was erected during the year to get the value of, or the cost of land and buildings at the beginning of the period. So that's what we're going to do. 1,500,000 rand or 1.5 million minus 600,000 rand, which was for the building which was erected during this period, equals 900,000 rand. So that was the cost of land and buildings at the beginning of the period. So let's put that in, 900,000 rand. Next, we look at equipment. Let's identify equipment in our table. We have equipment at cost, which is 280,000 rand, and that is at the end of the period. So what we want is equipment at the beginning of the period. So what are we told? Let's look at the additional information as well. We are told that on 30 November 2010, that is during this period, equipment with the cost price of 35,000 rand was sold at a loss of 3,000 rand. At that date, the accumulated depreciation on the equipment sold amounted to 12,060 rand. All the transactions regarding the sale was recorded correctly. So what do we do with that? Remember, we are given equipment at cost at the end of the period. So this is at the end of the period, but we want how much the equipment was worth at the beginning of the period. So now we know that there was some equipment which was sold during the period. So now we have to add that equipment which was sold during the period to see how much all the equipment was worth at the beginning of the period. So we take 280,000 rand and we add the equipment which was sold, and we add the actual cost of the equipment, which is 35,000 rand. So that is what we do. 280,000 rand plus 35,000 rand equals a total of 315,000 rand, and that is what to plug in under equipment. So you can see that dates play a huge role when we're doing our PPE notes, so we need to pay very careful attention to them. Next, we look at the vehicles. We are given a vehicle at cost at the beginning of the period, which is 170,000 rand. No, sorry, at the end of the period, because we're told these are balances as of 28 February 2011, and that's when we're preparing the PPE note. So we're given vehicle at 170,000 rand. Now we go to additional information to see if there was any movement to vehicles, whether we purchased or sold vehicles. We can see from additional information there is nothing that speaks about vehicle here. That means there were no movements in vehicle, so that's the easy one. So we just put the 170,000 rand under cost at the beginning of the period. So now we've done the cost at the beginning of the period for all the non-current assets that we had. So we put it under total, gives us a total of 1,385,000 rand. Now let's look at accumulated depreciation. How do we do the accumulated depreciation? Remember, this accumulated depreciation is accumulated depreciation at the beginning of the period. So not at the end of the period, because we're also going to do the accumulated depreciation at the end of the period. And we also know that there's a difference between depreciation and accumulated depreciation. If you'd like to understand more on that, you can click on the link on the top right of the screen, or you'll find the link in the description as well. So let's find the accumulated depreciation at the beginning of the period. For land and buildings, now remember, we were told, or we found out that at the beginning of the period we didn't have buildings yet. We only had land, and that's why we only have the cost of 900,000 rand. And what do we know about land? Land does not depreciate, so it does not lose value over time. In fact, it appreciates over time. So at the beginning of the period we only had land. We didn't have building yet in this section, so we didn't have any depreciation for land. So we're going to see that land and buildings was 1,500,000 rand, but that included the building which we purchased at the end of the year. So we know at the beginning we only had land, so we did not have depreciation for land, so I'll put a dash there. Let's move on to equipment. Did we have depreciation for equipment? Let's go to our table again. We see we have equipment at cost. We are given equipment at cost, and then we are also given accumulated depreciation on equipment, and we're given the dates there. So accumulated depreciation on equipment is 80,000 rand, And then why are we given the date 13 November 2010? Let's go to our additional information. Our additional information 2.2 tells us that on 13 November 2010, that is during this period, equipment with the cost price of 35,000 Rand was sold at a loss of 3,000 Rand. So we did sell equipment during the year. At that date, the accumulated depreciation on equipment sold amounted to 12,060 Rand. All the transactions regarding the sales were recorded correctly. So that means this accumulated depreciation that we are given in our table here does not include the accumulated depreciation relating to the equipment that we have sold. Did you get that? I'm going to say it again. The accumulated depreciation that we are given here, which is written 30 November 2010 in brackets at 80,000 Rand, does not include the accumulated depreciation related to the equipment which was sold. We want the accumulated depreciation at the beginning of the period. So we have to take this 80,000 Rand and we add the accumulated depreciation for the equipment which we sold, because we had this equipment at the beginning of the period. So we have to add all the depreciation that we had at the beginning of the period. So what do? We look at the depreciation here on equipment as at 13 November 2010. We note that this depreciation only relates to the equipment which was sold, because we recorded because the depreciation which was sold, depreciation which is recorded here is relating only to the equipment which was sold, as we can see the date here, equipment as at 13 November 2010. So let's see, how do we get the accumulated depreciation at the beginning of the period? We take the 80,000 Rand which were given in our table here, which only relates to depreciation for the equipment which is remaining. It does not include the depreciation for the equipment which we sold. Now we have to add the depreciation for the equipment which we sold. The reason we are adding is because we had it at the beginning of the period. So we want the accumulated depreciation at the beginning of the period. And then what do? We add back the accumulated depreciation relating to the equipment which we sold, which was 12,060 Rand. So we put that there. And then what do also? We deduct the depreciation for this current period relating to the equipment which we sold. Why do we deduct this 1,860 Rand? We deduct it because this is depreciation which was incurred during this period relating to the equipment which we sold. We want the accumulated depreciation at the beginning of the period. So that is why we deduct the 1,860. Remember, this 12,060 Rand relates to all the depreciation for the equipment which we sold, which includes this 1,860 Rand. I hope that makes sense and it's not confusing at all. If you look at the scenarios, if you look at the table and you read this carefully, you should be able to figure out how we got these figures. The 80,000 Rand is from the table, which does not include the depreciation for the equipment which we sold. And then so we're adding back all the accumulated depreciation for the equipment which we sold, and we deduct the depreciation for the equipment which we sold because it is included in this 12,060 Rand. So that's how we get the 90,200 Rand, and that's where we will plug in the amount under equipment accumulated depreciation at the beginning of the period. Let's move on to vehicles. Vehicles, we are given vehicles at the cost of 170 Rand, and then we are also given accumulated depreciation on vehicles on the 1st of March 2010. That's what we want. Remember, we want the carrying value on the 1st of March 2010. So we want the accumulated depreciation at the beginning of the period. And we can see in additional information, we're not given any more information on vehicles. So that's an easy one. We're just going to plug in this 24,000 Rand because it's accumulated depreciation at the beginning of the period. If this was accumulated depreciation at the end of the period, that would mean that we need to deduct the depreciation for the period. But this is the accumulated depreciation at the beginning of the period. So we just deduct the 24,000 Rand. Now we total the three up, we get 114,200 Rand. So that is the total accumulated depreciation. Now what's the next thing that we do? We take the cost minus the accumulated depreciation for each specific non-current asset to get the carrying amount as at the beginning of the period of 1st March 2010. So I've just done that. You can see the totals of the carrying amount at the beginning of the period. Let's move on to additions. Let's look at additions for land and buildings. Did we have any additions for land and building? Let's look at our additional information. We're told that land was bought on the 1st of March 2008. So that's before the beginning of this period. So that's not an addition. But then we are told the building was erected during the year. So that means that's an addition. So now we have building during the year at the cost of 600,000 rand and was only occupied on 1 January 2011. So we did have an addition of building. How much was the addition? 600,000 rand. So we plug in the 600,000 rand for building under land and building section. Then equipment, we look at equipment. Did we have any addition to equipment? Well, let's look at our additional information. The only thing on equipment is when we sold the equipment. So it's not an addition, it's a disposal. So we have nothing on equipment. So we'll put minus. And then on vehicles as well, if you can look at the additional information, there's nothing. That's why I put a dash there because there's nothing. And then we put our total, which was 600,000 rand. And it's only for buildings, which was added. Now let's move on to disposals at carrying value. Let's look at our additional information. Did we dispose of land and buildings? No, we did not dispose of any land and buildings. So we put a dash there. And then let's look at equipment. Did you dispose of equipment? Well, I'm sure by now you should know we disposed, and we looked at that in 2.2. On 30 November 2010, equipment with a cost price of 35,000 rand was sold at a loss of 3,000 rand. Now look at this description. It says disposals at carrying value. Always important. You have to put disposals at carrying value, not at cost. So when you have a disposal, you put it at its carrying value, how much it's worth at that specific time when you're disposing of it. And how do we get carrying value? We get carrying value by taking the cost price minus all the accumulated depreciation related to that specific asset. So we're going to take 35,000 rand minus 12,060 rand. So I put a plus there, it's a typo, it's a mistake. So you'll put a minus 12,060 rand, and then you get 22,940 rand, and that is the value of the equipment at the time at which it was disposed. So that's the carrying value of equipment at disposal. So we take that figure and put in 22,940. Remember, it's a disposal. Equipment is leaving our premises, so that's why we put it in brackets as a negative. What about vehicles? Did we have any disposal of vehicles? We know that in additional information, as we can see, we did not have anything on vehicles, so we did not dispose of any vehicle. So we put a dash there, and then we put our total there, which was only the disposal of equipment. Put it 22,940 rand, and it's in brackets because it's a disposal. Now let's move on to depreciation for the year. Remember, first we calculated the accumulated depreciation at the beginning of this period, and then now we are doing depreciation for this current period. Now, how do we do the depreciation? Let's look at depreciation for land and buildings. Now, like I mentioned before, land does not depreciate, so we know that one. We're not going to do a calculation on land, but this is land and buildings, and we know that buildings do depreciate. So we have land of 900,000 rand and building of 600,000 rand. So we have to calculate the depreciation on building. Now let's read the description. It told us that the building was erected during the year at the total cost of 600,000 rand and was only occupied on 1 January 2011. So we only start depreciating the building at the time at which it was occupied, from the time at which it was occupied. When are we doing our PPE note? We are doing it as at 28 February 2011. And the building was only occupied on 1 January 2011. So that means the building was only occupied for 2 months. That's the whole of January, because it was occupied from the 1st of January. So it's the whole of January and the whole of February until February 28. So that is 2 months. And we're also told that depreciation is calculated at 2% per annum on building on the straight line method. Also pay very careful attention on whether the building was depreciated or on whether the non-current asset was depreciated on straight line or diminishing balance method. If you'd like to understand more on the two methods, you can click on the link on the top right of the screen, or you'll find the link in the description below. But buildings are depreciated at 2% per annum on the straight line method. So let's do the calculation. We take 600,000 rand, which is the cost of the building, times 2% per annum, times 2 months. It was only occupied for 2 months in this period, because that's January and February, times 2 months divided by 12 months in a period or in a year, and it gives us a total of 2,000 rand. So the building got depreciation during the year of 2,000 rand. So we put in 2,000 rand in brackets because it's depreciation, it's depreciating our assets. Let's look at depreciation for equipment, specifically for equipment. Now we know that for equipment we did dispose of some equipment. So now we need to pay very careful attention on how we're calculating the depreciation. How do we get the depreciation? So we know that we have equipment at cost, which is 280,000 rand. And then we're also given accumulated depreciation. Remember, this accumulated depreciation relates to equipment which remains. It does not include the depreciation for the equipment which was disposed of. So we have 80,000 rand for equipment which was remaining. And then we also had depreciation for the equipment which was disposed of, which was 1,860 rand. So what is the depreciation for the year? Now we have to take the depreciation for the equipment which is remaining plus the depreciation for the equipment which was disposed of, because we still need to record and take account of that. And how do we do that? We take the equipment for the depreciation for the equipment which was disposed of, which is 1,860, and that's what we have here, plus we calculate the depreciation for the equipment which remains. Remember, it was at the beginning 280,000 rand. Okay, first let's look at 2.3. We're told that equipment 10% per annum on the diminishing balance method. And with the diminishing balance method, you calculate the depreciation on the carrying value. And we get the carrying value by taking 280,000 rand, which is the cost price, minus the accumulated depreciation of 80,000 rand. So we take 280,000 rand minus 80,000 rand multiplied by 10%, because that's what we're depreciating the equipment at, we were told. And then it gives us a total of 21,860. So that's depreciation that is remaining in our business, plus the depreciation for the equipment which is remaining in our business, plus the depreciation for the equipment which was disposed of 1,860. So all the depreciation for this period alone was 21,860. I hope that has made sense as we go along. So put down 21,860 rand, and it's in brackets because it's a it's a deduction from our assets. Our assets value is decreasing. Let's move on to vehicles. What is the depreciation for vehicles? Well, we can see from additional information we did not dispose or buy any vehicles, so it's going to be easy to calculate that one. And we have vehicles at cost of 170,000 rand, and we are told down here that vehicles 20% per annum according to the straight line method. So straight line method, we're just going to take that 20% multiplied by the cost price. So what we're going to do is 170,000 rand times 20% equals 34,000 rand. That is depreciation for this specific year. So we put that in brackets, 34,000 rand, and then we add them all together. It's 57,860 rand, and we put them in brackets. So now that we are done with the movements during the year and the depreciation for the year, we do our last section, which is carrying amount as at 28 February 2011 or as at the end of the period. Now it's similar to what we did at the beginning, but that was for the beginning of the period. Now we are doing for the end of the period. Where do we begin? We begin with the cost. So now what is our cost of land and buildings? Our cost of land and buildings is given here in our table. It's 1.5 million rand. 1,500,000 rand. So that is our cost, because it's the 900,000 rand for the land plus the 600,000 rand for the building, which was added during the year. So we have 1.5 million rand. And then equipment. What is the cost for the equipment? Remember, we are given the equipment at cost at the end. Remember, balances as at the end of February, as at 28 February 2011, and we were not given any dates in brackets, so we assume it is at the end of the period. 280,000 rand, so we'll put that down as the cost. What about vehicles? What is the cost of the vehicles? We know that there were no movements in vehicles during the year, and we are given there 170,000 rand as at 28 February 2011, so we plug that in, and then we get our totals, 1,950,000 rand. And then we move on to accumulated depreciation. Now remember, this is all the accumulated depreciation relating to our non-current assets that remain. For the assets that remain, only the ones that remain. So we take accumulated depreciation for the assets that remain. So how do we get that? The depreciation or the accumulated depreciation for the land and buildings is 2,000 rand. How did we get 2,000 rand? Remember, depreciation for the year was 2000 rand, and that was relating to buildings which was acquired or was erected during this specific year. And we know that land does not depreciate, so the only depreciation we have relates to the building. So that was 2000 rand, which we calculated earlier on. What about equipment? What is the accumulated depreciation on equipment? Now we know that there were movements in equipment, or we disposed of equipment. That's what I mean by movement. We disposed of some equipment, so we do not include accumulated depreciation for that specific equipment. So what can we do? Well, we take the accumulated depreciation at the beginning of the period, we add the depreciation for the year, which we calculated, and then we deduct the depreciation for the equipment which we sold, the accumulated depreciation for the equipment which we sold. So we take the 90,200 rand, which is given here, which we calculate at the beginning of the period, accumulated depreciation, plus the depreciation for the year of 21,860 rand, minus the accumulated depreciation for the equipment which we sold, which is 12,060 rand. And that is how we get the 100,000 rand for accumulated depreciation on equipment at the end of the period. So we put 100,000 rand there. Let's move on to vehicles. How do we get the accumulated depreciation on vehicles? Well, we know that there were no movement in vehicles, so we know that the accumulated depreciation on vehicle is very easy. We're just going to take accumulated depreciation at the beginning of the period plus depreciation for the year, and then we get the accumulated depreciation at the end of the period. So it's 24,000 rand plus 34,000 rand equals 58,000 rand. So plug that in, and then we add our total, so we get 160,000 rand. So now how do we get the carrying value at the end of the period? We take the cost minus the accumulated depreciation. We get the carrying value at for each non-current asset at the end of the period. So we do the calculation, and then we get our totals there. So this is where we wanted to get at, to get the carrying value at the end of the period, and that is the PPE note. It looks specifically at non-current assets and their movements during the specific period at which you are calculating it. I hope that has made sense and it was not too complicated. Remember, pay attention, very careful attention to the dates you are given. Pay careful attention to how the non-current assets are depreciated, whether it's straight line method or diminishing balance method. And pay careful attention also to the movements that and their dates, when they were disposed of and when they were bought, and that will affect how you calculate your depreciation, because it may not be depreciation for the whole year but for part of the year, like we did with buildings. I hope that has made sense. If you have any questions or queries, you can leave them in the comment section below. But if you've gained value from this lesson, or you've learned something from this lesson, please consider subscribing to our channel and liking our video. That really helps us, and sharing this video if you can. Till next time, cheers.